Hey guys, welcome to Beast Investing. My name is Luke. I hope you guys are having a great day as usual. Today we will be having our course number 1 of the Beasts of the Market courses, okay? So these are meant to bring you from a brand new entry-level investor that doesn't know anything about finance, business, or money, all the way up to being able to put your first dollars into the market. So the course number 1 will be about intro to investing, all the absolute basics. So first thing we'll be covering today is the basic definition of investing. We will follow that by what is the difference between an asset and a liability. We will do a brief introduction to stocks, okay? And we will also talk a little bit about valuations. First off, the basic definition of investing, okay? It is the process of using capital to build future wealth. In other words, we are taking our own money that we've already worked for and gained. We're putting it aside somewhere so that could generate us future profits, future wealth, okay? So as you can see here, it would be $100. We lock it away for 10 years and it becomes $200. So as you can see, the components of investing is having original amount of money, putting it away for a certain amount of time, long term, and in the future, you will have a bigger amount of money, okay? This is what is building wealth, okay? Also, you will be able to build long-term wealth, except it is not an overnight get rich quick, okay? That does not exist. People will always try to sell you that dream, except it just clearly does not exist, okay? It is a long-term process with a lot of little steps, a little bit of gains here and there, and long-term it adds up very, very big. The main goal of investing, okay, it is to make money work for you, okay? When you go to your job from a 9 to 5, okay, you are trading your time for money, okay? And you're trading your work, you're trading effort for money. Before becoming an investor, you obviously have to accumulate a bit of money and you have to go work, okay? But when you're investing, on the other hand, you are not working for the money. You're making that money that you've already made work for you, okay? You could actually make money in your sleep. Now, what is very important to understand when it comes to building long-term wealth is assets versus liabilities, okay? First of all, definition of an asset. It is something that is putting money into your pocket. A liability is what is taking money out of your pocket, okay? So they're complete opposite things, and obviously one is better than the other for building long-term wealth. First off, what are examples of some assets? If you have a house and you're renting it out and your tenant is paying your mortgage for you, that is an asset. Remember, a tenant is giving you money. That's an asset. A job, you are going to work for something, that means that thing is giving you money. Again, your boss or whoever owns the company is giving you money to work. It's an asset. Stocks, you put money in stocks, your stocks pay you out a dividend. We will be talking about this obviously in the future. All of these are examples of things where money is going into your pocket. Now we will be talking very quickly about the examples of liabilities, okay? When you buy a nice car, that is a liability. When you buy expensive clothes, liability. Vacations are a liability. Food, liability. And house. Now you may be asking yourself, wait, but I think we saw house on the other one. Yes, but there's a very big difference in between me living in a house and that house being a rental property, okay? When I'm living in my house, I am actually paying my mortgage and money is coming out of my pocket. Someone that wants to build wealth, we don't want money coming out of our pocket. We want to buy things that are going to put money in our pocket. So mind you, things like a car, that could also be an asset. Technically, if you're using your car to drive for Uber, let's say, and you're getting paid to use it, that is an asset, okay? So there is a kind of a gray zone, but the way it's decided is that an asset puts money in your pocket, the liability takes money out. As an investor, you want to build long-term wealth. That means you want to focus on buying assets. You want to be buying assets very often, as often as you could, to take advantage of compound interest. Again, we will be discussing this further on in this course. The next thing we will be discussing is how exactly a business works, okay? I'm gonna simplify it very much. What's important is that you remember the terms that I use, because these terms, although they may seem simple, are extremely important in being able to invest in the future, okay? Number 1, we have our consumer, okay? So that's our everyday shopper, all those kinds of people. They will give money to a business, okay? This money is called revenue when we're looking at it from the business side, right? So the original money, the first dollar that comes in, that's revenue, also called the top line, okay? After that, this business has expenses, right? Not all that money goes directly as profit, right? I have to pay, let's say in McDonald's case, I have to pay rent. I have to pay for my staff, salaries. I have to pay for all the patties. I have to pay for all the food. I have to pay for, all the cleaning. I have to pay for electricity. There's a lot of expenses involved, right? So what comes out of that business is called expenses. So you have your top line all the way at the top, then you have all your expenses, and then after that, you have a little difference. Hopefully, if you have a profitable business, you have a difference amount of money after you pay off all your expenses, okay? That money is called the profit, okay? So you have top line, then you have expenses, and then you have profit or bottom line, okay? We call it either way, okay? So this profit, you may be asking yourself, who does it go to? Obviously, it goes to an owner. There is an owner that owns this business, and they're the ones that are collecting that profit. So remember, profit is revenue minus expenses equals my profit, okay? So in this case, we are assuming that there's one owner, and the guy's name is Paul. He owns this McDonald's, so he is the one that receives all the profit. Now, our next situation, okay, we're gonna spice things up a bit. We will be talking about a public company and what's the difference between a private. So first of all, a private company is the exact example like we just saw. You have the consumer business, and then the owner is just one person. One person bought a McDonald's franchise. He is the one owner. Now, when you talk about public companies, it's a company that's listed on the stock market. This means that any investor that has money to invest can invest in those companies. So again, McDonald's, Starbucks in this case, Coca-Cola, Costco, Apple, Amazon, all those companies are on the stock market. Hence, you could invest in them. They are called public companies. So what's important to know, okay? When you buy stock in a company, you are a part owner. Like in our example before with Paul, the owner of the McDonald's, he was an owner, okay? He received the profits, okay? When you are a part owner, so a shareholder, you are also entitled to those same profits, okay? It's the very same concept. We're gonna use Starbucks as our example. So let's say this is all of what we know about Starbucks company, okay? First of all, what we will notice is that there is 100 shares outstanding. What this means is that Starbucks as a whole is a pie, okay? In this case, it is divided in 100 equal pieces. So those 100 equal pieces can be bought by anybody. I could buy how many pieces I want, depending on my money. Now, what we will see is the revenue in our hypothetical case here is $100,000. So remember, revenue is the first money that came into the business. The dollars that the customer gave to the cashier, those are the revenue dollars, okay? Then we had expenses. In this case, expenses are electricity, rent, employees, everything. Same example as before. Original profit, we have to pay tax. Everybody pays tax. Corporations also pay tax. Also, corporation is just a fancy way of saying a business, okay? So this tax expense, in our hypothetical situation, is $10,000, okay? The expenses were 60. So if we add total expenses, which is the expenses plus the tax expense, we come out with total expense of $70,000. They come out of the top line revenue. So we do top line minus expenses equals $30,000. So our profit, which is also called net income, very important to remember. Obviously, net income is $30,000. Okay. So since you are part owner of this business, you are entitled to this $30,000. It is partly yours. Depending on how much percentage of the company you own, you are entitled to that same percentage of that $30,000 of profit, okay? So in our other example, we're gonna say you own 10 shares out of the 100 that are outstanding. So that total amount of pieces, you own 10 of them. So you own 10% of the company and are entitled to 10% of the profits, okay? It's important to know. Your 10 shares in Starbucks are giving you a total profit of $3,000. That is technically what your shares are paying you every year if the revenues and profits stay the same. Those positions are supposed to pay you $3,000. That is where you get value as an investor. You are investing in a business, you are a part owner in this business, and you are entitled to their profits. So in our previous example, there was $30,000 of net income. Remember, net income means profit. Very important to remember. And 100 shares outstanding. Okay? So that means if you take the total number of net income, the $30,000 here, and you divide it by 100 pieces of the cake, so 100 shares outstanding, you get $300 of profit per share, okay? This term is called earnings per share, or EPS. It's just the acronym EPS, okay? This also is super mega important because this comes back many times throughout this course, okay? So the earnings per share of this company is $300, okay? Now, I'm going to ask you a question. How much are you willing to pay to receive this $300 per year? So how much do you want to buy one share of this company for, okay? Now, this might be a very foreign concept, but this is the absolute basis of investing. I have a business that generates profit. Now, I have to decide as a potential shareholder how much I'm willing to buy that piece of profit for, okay? So, in this example, if I require a 20% ROI on my money, okay? So I want a 20% return. ROI means return on investment. I want a 20% return on my money. If I wanted that 20%, I would have to buy this chunk of earnings per share for 1,500. So that would be our hypothetical share price that I'm willing to buy this $300 for. And let's say if I'm happy with 15%, I'm willing to pay $2,000, okay? If I'm happy with 12%, I'll pay $2,500. If I'm happy with 10% return on my money, I am okay with a $3,000. What this brings us to is another key term or concept to remember. It's called the PE ratio. This is what we call an earnings multiplier. It's the premium you pay to own part of the profits, okay? If a business generates $300 of profit, if I'm able to buy it for $300, that means I repay my whole investment in 1 year, okay? This is not realistic. Nobody will ever sell me $300 of profit for $300, okay? There's always going to be a premium above it that I have to pay. This premium, obviously, we want it to be the smallest possible because as we can see in our table, the less amount we pay per share, the higher our return is, okay? And obviously, as investors, we want to try to maximize our returns, everything else being equal, meaning risk. So if I absolutely, which me personally in investing, I aim for a 15% return. This is also what legends of investing like Warren Buffett also want, is 15%, okay? If I'm happy with 15% ROI, that means I'm willing to pay $2,000 for this. Remember, I'm buying the earnings per share, the $300. I'm willing to buy this $300 per year for $2,000. This means I am paying a PE ratio of 6.67. Now again, if you didn't get it, this PE, what it is taking the $300 multiplied by what equals 2,000. Another way to think about it is $2,000 divided by what equals 300. So it's just the way of connecting the earnings, which is the profit, which is where my value comes as a shareholder, to the price I have to buy that piece for. And that's going to be the price that's on the stock market, the one that moves all the time that you see in movies and everything. That's what we're talking about. It's this $2,000. That's the one that moves. The earnings per share, that it comes out as the company posts their results. Concepts we have to remember here are, first of all, net income, which is the profit, the total profit generated by my business. I have to remember shares outstanding, which is how many pieces of the pie it's divided by. So how many pieces are there to the pie? In this case, it's 100 pieces. Another term is the earnings per share. This is the amount of earnings per piece of the pie. I would say our PE ratio is super important, and the PE ratio relates to our return on investment. the higher the PE ratio, as we can see. So the further up we go, the lower our return is. So we obviously want this PE ratio to be the lowest possible, because when it was 5, we got 20%. When it's 10, we got 10%. So to review, what we have learned in this course is, number 1, the basics of investing. Remember, it's the long-term accumulation of wealth. We learned that the difference between assets versus liabilities, where a rich person, a wealthy person, wants to buy as many assets as they want and limit the liabilities as much as they can. We learned how a business works, and remember, we have the revenue minus expenses equals profit. Okay, we learned what that is, and we learned that the profit is the one that goes to the owner or part owners if it's like on the stock market and we could buy shares from that company. And we learned how to value a company. So the intro to valuations and why the price I pay for that amount of money directly affects my returns. Okay, so thank you very much, guys. Don't forget to obliterate the like button and subscribe. It was a pleasure giving you guys this course today. Stay tuned for future courses, and I hope you guys have a great day.